Despite busy season just starting, we're seeing a change in sentiment across the board. Here's an incredible survey result that came out that shows that 83% of people out there believe now is not the best time to purchase a home. This is one of the lowest times ever. Let's dig into why this is, what has been going on, and if you're a buyer, what could be holding you back? And if you're a seller, how realistic do you need to be in this market in order to get your property sold, especially if it's here in the Sunbelt? So here's the survey. This comes from a Keller Williams chart that came out. It says consumer sentiment is now a good time to buy a home. This has been something that has been going all the way back to the 60s. And this just says only 17% of people think right now is a good time to buy a home. This is one of the lowest levels ever that we've seen. And the reasons behind this may or may not be surprising to you. For a lot of people, they see the data and they just don't understand that now is one of the worst times in history to ever buy a home. But this consumer sentiment is really driving that home, saying, hey, actually, people are starting to catch on that now is not the best time to buy. Of course, the number one factor is affordability. What do you earn from a wage perspective versus what your monthly payment will be versus what the price is today? All of these factors are really important when you're considering buying a piece of real estate. As you can see, one of the levels of affordability, which is the principal and interest as a percentage of income, that's this orange line here versus the historic average, and the historic average from 2024 used to be in 1981, 49%. Okay, so we had a bubble in 1981, we had a bubble in 2006, and it became extremely unaffordable by 2023 at 34% as principal and interest as a percentage of income. And by the way, this does not even include the taxes and insurance and other items on top of this. This is just as a percentage of income. And so we're at 32% right now. This is a really big problem because we're actually seeing rates, even though it dipped right below 6%, we're seeing it pop right back up. It was 6.18%. I think it's a little bit higher even today because of what's going on with oil. And the reality is, buyers have an opportunity cost. So it's not always about what is my payment going to be. It's going to be what is your payment versus what you can rent basically the same exact property for in today's market, because buyers have options on what they can do. And for most properties out there today, because they're so unaffordable to purchase, renting is now actually cheaper. And this changes the entire dynamic of the business model. And because there's a lack of affordability, now we have 44% more home sellers than we do home buyers. And this gap is widening every single month. This comes from Redfin. And this is great data because it just shows you that the buyers are in control of this market moving forward, especially here in the Sunbelt. There's areas in the Northeast where the sellers are still slightly in control, but it's shifting very quickly and starting to take that advantage away from the sellers as inventory starts to come onto the market. The reality is, it's this simple. Prices just came up too much. Here in Florida, we had a 68% increase in home prices in just a short period of time. It's basically a decade of home price appreciation just within 2 years because of net migration to Florida, because we had zero interest rate policy, all of these different factors that played into just an explosion of real estate in the same state at the same time. And across the country too, because of the zero interest rate policy, record low mortgage rates, we just saw these existing home prices in this blue line here just skyrocket. And that caused prices to become unaffordable. You see that here in the orange line, and then pending sales drop. So when prices get too high, you see the number of transactions slow down, you see the listings stack up, and then you see the prices correct. And that's the next step of this cycle, is prices coming down in these areas where the prices no longer make sense for the median income. And this is a great chart that shows that. This is from Reventure. It says U.S. home value divided by the income ratio are near record highs. You can see how crazy it was in 2006. It was at 4.27. Well, today we're near 4.27. We're right there at 4.2. So we are just as unaffordable when you consider somebody's income when you're looking at real estate prices today. So prices just historically are overvalued. And how do we get back to this median here? Median prices? Well, we're going to have to see what we saw in 2006, which is a 30 to 40% decline in prices. Hopefully, it won't be that traumatic. It's probably going to be more regional than across the board. However, there's areas that are completely overbuilt already, and we're starting to see prices down 10, 15, 20% in many circumstances. And it's just the beginning. We really have seen the rest of the market kind of hold up. The stock market's, near record level highs, and all these other asset classes are at record highs. And real estate has been able to continue to slowly drift down, and it's going to be really interest rate dependent because we did see a small bump here locally. When rates came right below 6, we saw a ton of people jump in and start buying real estate again because their payments started to have a little bit of relief. However, I think that just reversed, obviously, with what's going on with oil prices right now and how that goes into CPI. So we're likely to see that rates actually move higher from here on out, unless we start seeing employment, which if employment drops, then if you don't have a house, obviously, if you don't have a job, you can't buy a house. So that just further softens the demand that we have that's already near record lows. So let me give you an example. Okay. So say you're in Jacksonville, Florida, you can buy a house for 375,000. A lot of people put 3-5% down. You can rent this house right now for $22,150, or you can buy it today and you can do a monthly payment. This includes taxes and insurance of $2,950. Okay. So this is an $800 difference. I want to ask you, and drop a comment below, would you rather rent this house today at where we are in the market cycle, understanding the amount of new construction, the amount of multifamily that we have in this city, which is a very high level of supply? Or would you rather rent that house? You could probably negotiate that price down too and maybe get a free month of rent because the house has been sitting vacant for 4 months. So tell me, what would you rather do? And I think this is where I think a lot of sellers get confused. You need to run this, if you're a real estate agent, you need to run these numbers for your seller to say, hey, why would somebody buy this house at that price? It helps them understand what the buyers are actually going through in this market and help them understand that they do have options other than buying a house. And look, the good news is this: prices are already correcting across the country. Unfortunately, we're starting to see 2.1% of mortgages now already be underwater. We're already starting to see up to 10% of FHA mortgages be underwater, a very high level of VA mortgages. Why? Because they only put 3.5% down in a lot of cases, or they put 0% down in the case of a lot of VA loans. And so immediately when they purchase the house, they're basically underwater if they purchased in the last 2 to 3 years here. And keep in mind, these underwater numbers do not include that 10% round trip in terms of selling costs, right? The title company, the loan company, all the closing costs, the real estate agent expenses to transact real estate. So when you include that in here, it's a lot more than people think for the number of outstanding mortgages that have negative equity. And the vintage year that I'm most concerned about are the 2021, late 2021, 22, 23, 24, and 25 mortgages that have been originated, which the 22 to 25 segment is about 25% of loans outstanding. It's the 25% that have a high level of leverage in the Sunbelt areas here that I think are going to have the most distress and start to show up first. And then I think it will start to spread across the country as the market changes, the employment market changes, the inflation situation changes. And a lot of this will be rate dependent. That's going to determine how fast this moves. But at the end of the day, the ratios are the ratios. And if wages don't keep up, then prices will not continue to move up. You have to have the next wave of buyers. And the thing about real estate is that it's priced on the next marginal buyer, the next marginal seller. So it's going to be the seller that gives up the price and then the buyer that executes on that price that's a lower price. And then it drives down all the comps for that neighborhood. So even though you have this phantom equity, it's not real equity until it transacts and it turns from wealth that's locked up into your house into actual cash. So it's just paper wealth at this moment. And we have a lot of paper wealth because prices went up, 50% plus just within a few years. However, it's artificial if you don't actually sell the house. And the good news is the renters are getting even more powerful. The vacancy rate for multifamily has moved up to the highest level since it's been tracked in 2017, and it's continuing to move higher. Every single month that goes by, this is a very good thing. We had a lot of overbuilding. The rent prices just skyrocketed within a very short period of time. So we need this relief for the next generation of home buyers. It's really hard for the younger generations to be able to go out on their own, rent an apartment, save enough money for a down payment to purchase a house and get in on the American dream because it's so unaffordable and there's such a high level of Americans out there living paycheck to paycheck. So this vacancy index is a good thing for the next generation. It's a bad thing for the current investors who oftentimes have high vacancy sitting for a couple of months. But the reality is if they just reduce their prices, the demand will come back. We know that's the case. So it's just going to take time for those sellers to realize, hey, I need to reduce the price and then things will work themselves out. Now, the price declines are not just in the rentals, it's also in prices. You can see this. This is 100 of the 300 major metros are now negative. Austin is leading the charge here. It's very overbuilt. There's some people there who say it's near bottom. There's other people saying, hey, Austin tends to overcorrect. It's likely we're going to see an overcorrection here in Texas. Punta Gorda is the second, Cape Coral, and you can see just down the list of the shift that we've had since 2022 peak, right? In March of 2022, the Fed came in and started jacking up their short-term interest rates, the overnight borrowing rate for banks, which influences the yield curve. So we just saw that happen, and then that just drove prices down in these speculative markets. And we expect the prices to continue to move down in our market, depending on where you are and how close you are to new construction. We can see 10 to 15 to even 20% declines in the prices from the peak pricing in 2022. But the buyers and the renters are back in control in these specific markets. But we're still seeing this show up. So why are we saying, we're seeing all these shifts and prices come down, but how can you have that be at the same time that a realtor.com is saying we have 4 million homes short? This doesn't really make a lot of sense because the inventory continues to stack every single month. The reality is that there's regional differences. There's areas in the Northeast where you have these not in my backyard folks who don't want the construction, who aren't building, and that's where you have a lower and lower supply. But in the Sunbelt where you could build, it's now an oversupply. So you have just geographical differences with where the jobs are located and where you could actually build homes that's causing there to be this narrative of a shortage of homes. It's not that there's a shortage of homes, there's a shortage of affordable homes for the next generation. And this is true even in the Sun Belt because the builders got greedy. They wanted the higher margins at the higher price homes. And it makes a lot of sense why they did that. They thought the net migration would continue forever, and it didn't, and it dried up. And now they're feeling the pain of that, and they're dropping their prices pretty rapidly. So look at this. This is the new houses for sale by stage of construction completed in new houses for sale by stage of construction and not started. So you can see that it's skyrocketed all the way up to the point where we're basically at great financial crisis levels without the pain really being seen out there in the marketplace across the board. But there is no narrative of a housing shortage in the Sun Belt. Many of our areas were actually overbuilt due to this speculation by the builders. And the shortage is truly just in certain pockets in the Northeast. Though I think with the unaffordability and a lot of the younger folks who are basically leaving the North because it's so expensive to live there, they're moving to other affordable areas where they can, really start their life. And I think this is going to be a problem for the Northeast. They also have a lot of aging inventory that needs a ton of maintenance and upkeep and upgrades. So I think the Northeast is, while it does have a lower amount of homes for sale, I think that there's some structural issues that will show up, especially with the silver tsunami over the next 5 to 10 years, where we could see prices in the Northeast really start to not only decelerate, but start to actually come down. And here's the truth. I like this chart. This is the rents versus permits across metro areas. It just shows you where you build is where you're going to get cheaper prices. So we're getting cheaper prices now in Austin. Austin's down back to 2020 levels for pricing. Raleigh, North Carolina, Jacksonville, Florida, where I'm at. And where you can't build, right? New York, San Francisco, there's areas where it's just like they make it so difficult to build. That's where the prices stay high. So this is where the builders went crazy and built a lot. And this is where the builders were unable to build for various reasons. And they were basically kept out of those markets. Building, for me, I think it's a really good thing. I think it would be better to have less regulation and more construction, again, for the next generation of home buyers to get in on the American dream at a decent price and not at these peak market prices. But what's the issue right now? Oil prices, you can see oil barrel is $74. You can see the spike that's causing the 10-year treasury to spike, is causing mortgage rates to spike. And basically, if we see a 10% spike in oil, it can cause CPI to go up. And that'll, if CPI goes up, it's more likely that we will see the rate declines from the Federal Reserve. And that could be a huge issue for the housing bulls out there. And I think that this will slow the Federal Reserve, the FOMC, from deciding to do a rate cut at their next meeting. So I know people are saying, hey, we only expect two rate cuts between now and the end of the year. But if with oil spiking, if it remains elevated, then it's possible we might see no cuts, and that would be a huge issue for housing. We could continue to see the 10-year treasury and mortgage rates move up moving into the future. So this is something that could hurt the market and stall it out moving forward. So I'd love to hear from you. Do you think that the Fed will keep cutting rates as inflation starts to rear its head again? And do you think now is a good time to actually buy a house? And if so, if you really do think that, I want to hear why that is, and I want to hear where you are located. Also, drop below. If you own a house, how much could you rent that house out for versus what somebody would have to pay for a mortgage payment today, including the insurance and taxes? I want you to do the math and then drop below. I'd love to hear where you're coming from. As always, you can follow me on Substack. My information's below. And you can follow me on X at John Brooks. Thanks for following. I'll see you next week.